Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
Welcome back to another episode of the Defence Property Podcast. Last week's episode was an absolute hit. The crowd went roaring for Tom to come back in the studio, and we're just talking through, I guess, looking forward now. So last week's episode was all about Tom's journey building a portfolio of 2 properties while serving in the Defence. He's transport, 22 years old. Welcome back to the podcast, Tom.
Thanks, Kane. Look forward to it.
Nice, mate. Well, so just to, I guess, not everyone that's listening today would have listened to last week. So give us a Soldier's 5 on Tom's, high-level portfolio and journey with Defence and everything.
Yeah, okay. So started investing super young, education, books. First property around 19.
Yep.
Second property last year, July, settled in September. So pretty much just investing and just reading and research and just, building the foundation. Yeah,
so I've known Tom for a little bit now, super keen on education, super keen on getting help and building that A team and just getting the right advice. He considered going down the path of investing with family and quickly realised probably a lot quicker than other people would. Like normal people go, it's very natural to go down that, I'm going to invest with a sibling or going to invest with mum and dad. And in many cases, it can be right or wrong. There's no cookie cutter here. But Tom identified very quickly it wasn't going to be the right path for him and has, gone down this journey himself and built 2 properties, 22 years old. So now, today we're just going to talk through sort of what's the next move for Tom. But before we get into the nitty gritty of the portfolio and the property side, what's the thought process on the career, Tom? We touched on it last episode. Rozo's up in April. What are your thoughts?
Yeah, man. So essentially just obviously going to go back to my key foundation, education. Yep. So obviously, noting that I do want to build, a substantial property portfolio. Yep. I'm quite capped at the income I'm on, or obviously if I continue the route that I'm going down now, it's going to take a very long time to keep accumulating like property itself or other investments. So we've identified that. All right, we need time to get a career change. I'm obviously passionate about something. Not too passionate about the trucks itself, but I found something that I'm passionate about. Yep. So as we just spoke, like yesterday, we were speaking a couple of days ago on Saturday. Yesterday, I just made another investment in myself, $6,000 into, education for sales. Yep. And essentially, I'm going to be looking at going down that route of sales, buyer's agency, and, getting more involved in the space and networking with people in the space. And then, it might suck eggs for the first couple of years. You're going to make some low money, but, that'll hopefully build itself up and I'll earn some bigger money one day to invest in more property. Yeah. So I guess the main thing I'm kind of saying is like, essentially, you might go to little money for a bit whilst you're building that skill before you earn, that big money.
Yeah. So a sideways or a backwards step to keep going forward. And it's key, I guess, important to mention for, a lot of the listener base and stuff, like Tom's really craved this as a career change and has got a very clear passion for real estate and the industry and stuff. But also if you're a self-declared lifer in Defence, there's a very clear path of known promotions, as you progress through the ranks. And with each promotion comes a salary increase. So you can actually model your portfolio off, if you're unlocking 10K, that's a year with a promotion from digger to corporal or corporal to sergeant, that's $200 a week. That's another property in holding. I remember looking back when I was in Defence, every pay increase I got was transferred into the currency was also how many properties that allowed me to hold,
Yeah, most definitely.
But I guess for Tom, it sounds like that's not fast enough. So we're going to break down, I guess, or look into transitioning to the industry. So have you started any courses or what's the path? Yeah,
like I just mentioned, just invested $6,000 in a mentor sales course just as of yesterday, which has been super beneficial. Obviously, haven't had enough time to complete that course or to comment on that course or to rate that course, but so we'll see how that goes. So that's another pretty like big investment to spend on yourself. Yep. Could have bought a car, could have went on a holiday, whatever it may be. Yep. And I'm here speaking with you now, which is another positive thing, and just going out and just expanding my network, man. Yeah,
nice. And watch this space, I guess.
Yeah.
But getting into the portfolio side, so if anyone hasn't listened to last week's episode, might be a good opportunity to go back and jump on that one so you're up to speed with Tom's journey. But we're essentially sitting on 2 properties. First one was purchased with a 10% deposit. The second one was purchased at a 90% LVR with equity released from the first after some pretty good growth in that first one. We're essentially, well, let's assume we're at borrowing capacity limits, but we'll start there. Have you spoken to a broker recently from the second purchase was only 6-9 months ago? Yep. So have you when did you last have that conversation around borrowing capacity with a broker?
Yeah, probably not too long ago, man. Yeah, itself. Yeah, spoke with a broker.
Yep. And what was their sort of feedback to you, like based on your current position?
Essentially, like we're going to have to look at purchasing properties in different structures.
Yep.
And sorry, we'll go back. I did actually change brokers from the first to the second.
Yep.
But yeah, obviously did my analysis, researched the broker.
Yep.
And then, landed where I was now. If I had went with the person that I desire to go with the first time, it probably would have been a different path.
Yep.
Probably wouldn't have purchased 2 properties in my personal name.
Yep.
But we're here now, you know what I mean? We're not paying stamp duty again or whatever it is to, transfer the ownership. So yeah, man. So essentially just looking at purchasing, different structures at the moment.
Yeah, cool. So when you're but you're essentially at your borrowing capacity limit after that conversation.
Oh
with the
yeah,
broker?
I would
cool.
be, yeah.
Yeah. So going forward, like what Tom's current position is, unless he has a drastic increase in income, a drastic reduction in debt levels, he's somewhat at some sort of ceiling of his borrowing capacity limit. So probably most importantly is, and it sounds like Tom's done that, the first broker is different to the second broker you used. Yep, for purchase price. So like we said in the last week's episode, potentially one broker is not the right fit for growing a portfolio. You might outgrow that broker, let's say. But the broker you want to be using is someone that's, I guess, in a position of where you want to go to. So
correct, yeah.
Having a multiple property portfolio. So we're just going to talk through a couple of different options or pathways for Tom, I guess, on how to continue growing the portfolio. And I guess one of my mantras in property is, how do I get to my goal, whether that's a 5-year goal, a 10, 20-year goal, in the least amount of transactions? Because transactional costs in real estate, whether it's buying and we got stamp duty on the way in, or selling and we got agent fees and capital gains tax on the way out, can be quite costly. Picking our markets really helps, accelerate some of the growth or front load it in the portfolio. But we want to, I guess, minimize the number of transactions, so we're minimizing those expenses. But the first one, when you really get to the borrowing capacity constraints, you are found in this position where we either need to wait a long period of time for the market to do some of the heavy lifting, get a bit more active in the portfolio from a more of a passive long-term buy and hold, or maybe find someone to get married and turn into a double income, no kids.
That'd be nice, yeah.
We're not in the Defence Property Podcast doesn't really play in the space of Tinder, so we'll scratch that strategy. Unless that happens, we can pivot and re-strategize. But I'd say the first path of getting, unstuck or moving to that next one is that sideward step to continue going forward. So, and possibly not now, but it could be now, 3, 6, 12 months. Tom's done or developed a fair bit of education in analysing markets. So he's going to do that same analysis on the market when he buys and potentially do it to exit one of his properties and move some debt into, make a purchase in a trust. So what we're saying here is sell one and then buy in a new market, in a new entity. A key caveat to this strategy is having the right broker, having the right accountant, and understanding the pros and cons of the strategy. And that's probably something that's beyond this podcast, but and it's no magic silver bullet that's just going to unlock all this borrowing capacity. But while the debt's in our personal name will be constrained, but if we can sort of employ a bit of a more sophisticated lending structure, it can unlock some borrowing capacity. So how does that sit as a plan? Selling one and then replacing it with a new purchase.
Yeah,
you might say Salisbury, for example, has been exhausted. Sell that, pay a little bit of capital gains, but then make a new purchase in a trust where you can pick a new market and isolate the debt.
Yeah, most definitely. That sounds like, a really good plan. Obviously, going back and having a look at the suburb itself, obviously because, I have the education and know how to, I can identify if the area's, gone a bit flat. I still, in my personal opinion, I reckon we do have another 12 months in that market, another, 15, 20% personally. I think so. I could be wrong, but yeah. And then, essentially just be, selling down one of those assets, getting the cash out, paying all the fees associated with that. And then, looking into purchasing into, another structure, maybe, a better quality asset or whatever it may be, or, something that, where the numbers are really stacking up so that, trust can really have a good benefit or like work alongside me, or whether it takes a little bit of time for the trust to, work for me.
Yep.
Something, around that realm, maybe a little bit something positively geared if we can, but I guess it's really difficult in this, in this market at this point in time.
Yeah, cool. So what sort of numbers would you look at with the suburb to identify if you were going to sell it now or in 12 months? Like, just talk us through some of your sort of favorite data points, I guess.
I guess I'd just wait for essentially I'd be going back now and I'd be seeing obviously how far Salisbury's, like Salisbury Downs, because there's multiple different Salisbury, just checking, my specific suburb itself, how well it's performed over the last, 4 to 5 years, seeing, what's happening in the area, just seeing the buyer demand itself, checking just pretty much all the main data points, rates, stock on market, ensuring that's not increasing the stock on market, make sure it's still low. And then ultimately after checking all our secret data points, we'll be able to, make that, informed decision. It might be the right time to sell, it might be, not the right time to sell.
And I guess for the people listening, so what this is essentially unlocking is once the property is in a trust and once that property is with the right lender and the accountant verifies its positive cash flow, we can go to a new lender and somewhat isolate that debt. So there's a very clear, specific set of rules that we need to follow when employing this strategy. And again, possibly something beyond this episode that we need to, if you're considering it. But just understanding that that's then unlocked the ability to make that third purchase just that little bit sooner.
Most definitely, yeah.
Isolating the debt out. I guess another option that we spoke about earlier was, you're considering, and this is probably the bigger decision at play that's then going to, lead into what path you go to accelerate the portfolio. But we're looking at a career change, knowing that you've got a fairly defined path with defence with your income levels. And how do you feel that that's going to help the portfolio grow?
Ultimately, it's just going to, we'll get out of that out, but ultimately it's going to help me, be able to make more money in the future, which is going to, increase borrowing power, let the market do its thing in the time, better my lifestyle, better my, investments and, essentially, overall become a better person, in my terms, being able to help people. Yep.
Yeah. So by doing this, I guess the pro to this strategy is definitely we're not selling a property. So we're avoiding a lot of expenses that come with that. And we're moving industries and careers, which again is going to help build knowledge. So there's quite a few pros to that strategy, but it is delaying another purchase. Whereas the first method or strategy, we probably didn't make that third purchase too soon anyway. We've got a step closer to that third purchase because we, shuffled some of the debt around, but we still needed to go through that process of the debt, becoming positive cash flow and the trust to do that. So option 2's, I would say, probably favourable, over the first option. But when you make that third purchase, what's your appetite for purchasing in a trust?
Super keen on it. Obviously liaise with the accountant itself and get the, appropriate information, as anyone should. Do your due diligence first on, your behalf. I'm ensuring you're making the right decision. But that's, if I have a look at, we'll edit that, but if I have a look at other investors and what they've done in their time and essentially just following their blueprint, everyone purchases in different structures, you know what I mean? There's only so much a personal name can hold, which is super important, for the audience themselves. But it just depends how, interested you are, man. If you're interested in, making that change and getting, really well established in the space, it's exciting.
Yeah, nice. And then I guess a third option, depending on how that career change takes place, we've got the option to just tread water for a certain period of time, let some of the market do the heavy lifting. I think Salisbury Downs in the first, 18 months increased in rent in over $100 a week.
Crazy, yeah.
Yeah. So by picking the right markets, Tom's really front loading some of not only the equity growth, but rental growth in his portfolio, which is helping it transition from that negative to neutral and positive over time. Picking those right markets is just accelerating it, whereas if we're buying in our local backyard without data, we're just at the mercy of the local market. But as the third option of just treading water and waiting, regardless of what happens with career, we're relying on building savings, which can help because we're offsetting debt and building cash position. We're increasing rents on 2 properties, and we believe the second property we're is going to do really well from a growth and rental pressure. So we could potentially be, maybe a couple of years away from that portfolio growing where it's going to allow the third purchase.
Yeah, and once again, like there's nothing wrong with that also if, people wanted to take that avenue as well, just letting the market do its thing and, keeping your career and doing what you're doing. It just depends on what you want in life, you know what I mean? Like personally for me, that staying in defense personally for me is like, that would be an option, but like because I'm so, interested and educated within, a different space, I believe that I'd be, best used somewhere else. You know what I mean? Nothing that I don't want to stay in defense. Like I love it, the cheap rent, the cheap food, everything, in that sense. But yeah, it's just about, I want to speed, sense of urgency. Let's get it done, Not everyone's interested in that, which is okay as well. There are other avenues.
Yep. I guess another avenue, and being 22, you're probably not ready yet, but the self-managed super fund, has that ever come into the thought process, or have you, you mentioned a lot of education and reading and consumption of material and stuff. Have you gone down that path of considering a self-managed super fund?
Yeah, I have read a little bit about self-managed super fund, but like, correct me if I'm wrong. Like, this is a while ago since I've read about it, but I do need to be like, operating my own business, working under my own ABN. Like, I need to have my own self-managed super fund.
Not quite. So you can be PAYG.
Okay.
You can just have a normal job and have a self-managed super fund. But the self-managed super fund has its own ABN, so that's possibly where you've crossed wires there. Back in, like, for any of the older folk listening to the podcast, if you're on MSBS and current serving like I was, you couldn't have a self-managed super fund in defence because it was a defined benefit scheme. And if you were sort of not financial advice and, speak to a financial planner to understand. And I guess it's very important, I would say, to learn about your super. But on the current scheme, there is the option to look at potential self-managed super fund. Knowing Tom's been in the workforce for, 4 years, or defence at least 4 years, I'd say the balance probably isn't there to start a property. But
yeah, most definitely.
It's definitely like, as we start making that third purchase to get to the fourth or fifth, that, as you've matured in your career and stuff, there's definitely that possibility that the balance might be getting closer to.
Yeah, of course, yeah.
And just understanding that, self-managed super funds are a highly regulated environment to be purchasing property, and it's a complete different set of rules. But it's another avenue that people go to when they get into that borrowing capacity constraints of how they keep scaling their portfolio. So that's another option there. Going back, obviously when I look at my journey with property and defence, and I'm sure, reflecting on your journey with the properties that you got, what would you do different with your portfolio now that we're sitting here with 2 properties with some sort of decision process in what path we go with our strategy? What would you do anything different in the portfolio?
Yeah, most definitely. I would probably, like, as I mentioned, just screen my professionals and my team, more efficiently, and just ensuring that I'm working with people that have done what I wanted to do and have achieved what I wanted to achieve, I think I probably would have slowed down that little tad, you know what I mean? Instead of, impulse buying and, making impulse decisions. But ultimately it's taught me a lot, that, we can talk about now and we can educate other people with. But yeah, just really ensuring that, I'll harp on it again, just follow the people that have done what you want to do. And that's probably like my best piece of advice.
Yeah. And I think, like, without being too hard on yourself, like, you're doing very well and you've got, it sounds like, 2 really good assets. You can only learn so much from reading the books, magazines, following the influencers or whatever. Like, there's an element of you got to get in there and execute as well and take action. Sounds like you're a pretty fast mover in just life in general, and you've gone to 2 properties really quickly, which is great. So, you can make an argument that slowing down a little bit was okay, but I'd also make a pretty strong argument you've done pretty well. But what about purchasing the second one or the first in a trust? Would you felt like, looking back at what you know now, would you have gone down that path?
No, most definitely. I probably would have, purchased the first one and then personal name just for, the first property. It is what it is, the fastest, easiest, smoothest transaction. But the second property would have been in trust all day.
Yeah, and the first one in your personal name, you get a bit of those tax benefits and stuff, which you inherently lose purchasing property in different entities. But it does sort of, that debt strategy that comes with building a portfolio.
Yeah.
The debt, the broker and the banker is the gatekeeper to the debt, and the debt's what allows us to build it. So the debt strategy is fairly critical, I guess. Yeah, so what are you gravitating to? Staying in defence and selling, buying, definitely making the career change?
Definitely making a career change for me personally.
So we're holding both properties as they are. Is that probably the clearer choice?
I think no, I don't really want to sell Salisbury in the next 12 months. I think I got, another 12 months in there, but it's definitely something I'll revisit in 12 months or the next 10 months. And then make a decision from there. But it was definitely, you just be, changing careers ultimately for me.
So the 12 months of holding and letting the current two make their move and room to breathe in their markets is going to allow you to focus on the career.
Most definitely, yeah.
Yeah, cool. And then further down, so, once the career's up and going, you've got possibly the third purchase, potentially, in a different entity. And then, the fourth or the fifth could potentially be, once your super balance is increased, there's a potential self-managed super fund on the cards as well.
I think just having that plan also is something I would have made a massive difference to me also as well. Like actually understanding why I'm buying and what I'm doing. Like, I can, this sounds quite stupid actually, but I did read all that. I understood the importance of a plan, but I was just so impulsive, wanting to buy, which I haven't done anything wrong. But, I think knowing what each property does for your portfolio and how it's going to get you to the next property and what structures and, reaching out and speaking with people, like just pick up the phone and ring. And you'll be surprised. Like people are willing to help you a long way, if you're, committed and, willing to learn. Yeah,
definitely. And just understanding like, what's right for one person isn't necessarily right for another. So we don't advocate for everyone going out buying in a trust. Like Tom's got a clear, appetite and desire to build a property portfolio. And at some point, purchasing in a different entity is going to make sense to allow him to continue scaling that. If you're sitting in defence and you're very happy, you might be on MSBS or even the current scheme. If you have no ambition to build a property portfolio to 4, 5 or 6 properties or beyond, you may not require, and it's a property in a trust or a different entity. Buying your personal name and just retaining those tax benefits could be definitely more,
most definitely,
more suitable. So it's about understanding and like Tom's mentioned over the last 2 episodes, the education piece, and the more that you know and having that right team is understanding the right move for you, considering all,
Yeah, of course. Even like with defence as well, Kane, like they go away for long periods of time. They can do so. That's even to me screams the more importance of having a team, having your buyer's agent that understands your position, your entitlements, having your broker, having your accountant, so you can comfortably go away for whatever it may be, 2 months to a week or whatever it may be, 6 months even, and know that you have people working in your best interest behind to ensure that everything's processing smoothly. Like I don't think I mentioned that, but for my second property, that was a big scare for me because I bought this property and I was like, it was a really bad mistake actually, stupid because I already owned the first property, but I didn't review the pest and building inspection. I just allowed like one of my friends to review the pest and building inspection for me, and I wasn't contactable. So anything could have came, like thank God nothing came back on that, but anything could have came back on that pest and building report and I would have been stuck, no matter what, I wouldn't have been able to negotiate any terms or even pull out of that deal because I wasn't there.
You'd hope he was a good mate.
Yeah, it was a good mate, but if I had a buyer's agent or whatever it may be, they would have been able to, be like, nah, all right, this is the problem. All right, well, we know Tom's away. We're allowed to speak on his behalf and we'll pull out of this deal. So the importance of a team, I believe, like, it could have went, horribly for me.
And I think in that scenario, having a solicitor that's one understanding of your instructions while you're away, but also really not a passive solicitor, and I don't want to say aggressive solicitor, but just like knows when to push their point and when to play the offensive position versus the defensive, because I've seen it many a times, worked with many different solicitors over the years, and they can make a huge difference in those building and pest and even the working order conditions that we discussed last episode. Very good. And big picture, Tom, talk us through, fast forward for me, 10 or 15 years career-wise, portfolio-wise, where are we sitting?
Hard one. So I do, and then people may laugh when I say this one, but I do want to have, a passive income of, $200,000 to $250,000, by the time, I'm in my 30s, late 30s, 40s. And running the numbers of all that, what I need, what I'm required. I'm essentially, I'm going to be looking at building up a quite large portfolio. If I give you the numbers now, I don't really have them on top of my head, but essentially just selling down those assets and buying one good commercial property or, keeping a couple good properties paid off that are, high yielding, whatever it may be. So essentially that's my property goal, is just to keep purchasing. And then, that's subject to change as well, which is cool, which is fine. And whatever happens, happens. But then, for the career as well, like I want to be earning some good money. I want to be educating and, helping other people in the space, do what I've done. But I think it's just time for me to, build a bit of a story and, make some mistakes and let other people learn and me learn off other people's mistakes and, ultimately get into sales, man. That's what I'm passionate about. I love speaking.
Yeah, love it. I mean, short and sharp, but pretty punchy. A few value bombs in that alone. Anything else to touch on before? Like any final tips for the defence audience based on, your short defence career, but property goals?
Just reach out to people. Use your buyer's agents. Use your, your professionals. Like as I mentioned in the first episode, like it'll be a game changer. Like you were mentioning in the first episode, don't listen to your uncle. Don't listen to people that have no idea of what you want to do. Follow people that have done what you want to do, and it will work wonders for you. Yeah.
There's I'm coming up close to probably 1,000 transactions as a buyer's agent with several hundred million in lending myself, and I always listen to people say, I might just do it myself and figure it out, but you just can't. And property is one of those things, if it goes all smooth and you can get lucky.
It can.
What's your metric from if it's going to be good or bad or a pass or fail from a due diligence? And you kind of just can't buy that experience of having an element of peace of mind. We don't sit here to promote having a crystal ball by any means, but we know with a due diligence checklist of 50 points of reference, we know it passes 50, versus if you're doing it yourself, what are your 50 items that you're referencing? Definitely consider, leveraging off other people's experience.
Most definitely, yeah.
As Tom has, I guess, through, in a 2-property portfolio at 22 years old, he's already outgrown his first broker and moved on to the second broker. So that just shows the maturity of the approach of understanding what he's looking for in his A team to help him build the portfolio. So, any final words?
Nah, just good luck, I guess.
Yeah, cool.
Good luck to everybody.
Well, thanks for listening. Again, reach out at discoverbuyersagency.com.au or look us up on one of many social channels. And thanks for listening. Till next time.